everyone. Hello, everyone. Good morning. It is Monday morning, March 9th, 2026. So good to see you all this beautiful Monday morning here in Austin, Texas. And let's welcome Maria is back. It is so good to have you back, Maria. So good to see you. Bertina said, hi, Maria. So good to see you. It is so good to see you, Maria. So glad that you are here with us. Yeah, we've got quite a few people here, and I am so excited to go over what is happening with Austin real estate. As you know, we started off the year saying, or I started off the year saying, why I am bullish for real estate in 2026. That was the first meeting, the first Friday meeting that we had. I laid out the rationale as to why I am bullish for 2026 in Austin, Texas. And it's all about affordability. When it comes to the median income to rent ratio, there's never been a time cheaper to rent in Austin, Texas. That's going to bring people in. That's going to bring employers in. And then, of course, we are seeing the price pressure on the actual sales price. And we're going to discuss that. And we are noticing the demand curve increasing quite dramatically, really encouraging how we're starting off 2026, especially compared to 2025, 24, 23. As you know, the market peaked May of 2022, but that's the lagging indicator. That's on the pricing side of things. The market started slowing down into 2021. Prices peaked 2022. So we've been at this now for 5 years, where every month, every year, it's like, okay, it's getting a little bit worse. It's getting worse. It's getting worse. And just now we're able to say, the leading indicators are now up year over year. So I cannot wait to share all this information with you all. And yet we are in the midst of chaos. We almost have to embrace a world of chaos. The email that I sent you this morning, pretty eye-opening. Oil got up to $111 per barrel. Yesterday, I sent a screenshot to Oliver. I'm like, yikes, check this out. And right now, let me take a look at the commodity market. Thankfully, it's under 100. It's actually at $98 per barrel. But to put in perspective, that's up 54% in 1 month. Barrel of oil up 54% in 1 month. And for every $10 increase in the barrel of oil, you're looking at about a 13-cent increase in the actual price at the pump. So we are going to start noticing that within the consumer's pocketbook. We've had a pretty decent run with good gasoline prices, good oil prices, but right now looking at right around $100 a barrel, and that's pretty brutal right there. And we're going to talk about the bond market. We're going to look at the economic calendar for this week, how to position our clients to lock in a favorable rate. I do have the rate sheet this morning from the amazing Robert. We're going to go over that information this morning. But we want to start off our morning by updating the famous new listing to pending ratio. What I view as the single best leading market indicator, where we weekly take a look at everything that's new on the market, everything that's back on the market, all the price increases, all the price drops. And we divide everything that's new on the market by everything that went active, under contract, and pending. And the whole point of this is really just the in and out. Out of everything that came into the market, what is the ratio of what was absorbed by the market? As you know, a ratio of 1 is considered that perfect market equilibrium, meaning 100 properties came into the market and 100 properties were absorbed by the market. Inventory should neither go up nor down. When the ratio is over 1, that means that 100 properties came into the market. And let's just say in the case of December 22nd through December 25th, in this case, the ratio was 1.31. So that means 100 properties came into the market and 131 properties were absorbed by the market. So what happens? Inventory goes down. And then when the ratio is under 1, in the case of 2 weeks ago, the ratio ended at 0.78. We're going to update the pending to see if that moved up a little bit. That means out of 100 properties that came into the market, 78 properties were absorbed by the market. So we do notice a pickup in inventory. And I do want to remind you that we update this on a daily basis. You can always go to teamprice.com, insight and statistics, click on the new listing to pending ratio, and it's going to give you the definition. When we're between a 0.6 and a 0.7, what I like to call that is a tangible increase in inventory. Inventory is building, absorption is steady enough to keep the market moving. It still slightly favors buyers. When you get between the 0.7 and 0.85, that's going to be your neutral market zone. That's going to be your perfect balance condition. Inventory is relatively stable. Neither buyer nor seller is going to hold any clear advantage. You get closer to that 1, it starts favoring sellers. And anything over 1, it's going to dramatically favor sellers. We want to take a look at this on a weekly basis so that we can have that real-time pulse on the market. What drives me crazy about the industry is that everyone is obsessed with lagging market indicators. And the top 2 lagging market indicators, sold price, months of inventory. It's important for us to know those figures, but that tells us what happened 30, 60, 90, 120 days ago. Even when you look at one of the most accurate, best, widely sourced data point is going to be let me pull this up. It's going to be the Freddie Mac. Let's go to the Freddie Mac. Let's find the Freddie Mac. Here you go. Freddie Mac House Price Index. This is updated once a month. The most recent one was posted February 27th. Latest data is for January. So this is posted February for January using the average of the previous 3 months. So that would be November, December, January. And this is super accurate. It goes all the way back to 1979. It uses like properties. I like this tool. It's great. I love it. Everyone reads it. Whenever I post an article or an X post on this, it just gets a ton of viewership. But it doesn't tell us what's happening with the market March 9th, 2026. It tells us what happened with the market 6 months before that. Because if you're using the average from November, December, January, you're looking at properties that closed in November. That means it went under contract in October. That means it came on the market. I mean, we're looking at median days on the market in the 50s, 60s, 70s. That's a listing that came on the market back in May. That's 10 months ago. That listing agent used data from 10 months ago to price that property to then affect this Freddie Mac House Price Index. So we've got to know it. Our clients are reading it. We've got to be able to explain this to the client, but we also have to know what is happening today. If I have a listing coming up, how am I pricing? If I've got a buyer right now, what am I doing today? What's happening with the market today? I don't care what the temperature was in August. I care about what the temperature is right now. So let's go ahead and start updating the historical, because we all know that agents are really bad when it comes to updating pending information. Everything in this list, new price increase, price decrease back on the market, it locks in at 11:59 at the end of this day. So tomorrow morning, when you come back and you're going to receive an email with this PDF, when you review this as a PDF, new price increase, price drop back on the market, it's going to lock and never change ever again. Active under contract is going to change slightly. Pending is going to change dramatically over the next 2, 3, 4 weeks because agents can update the information late. So we're going to update. This one stays the same, 567. Let's take a look at the pending. This is going to go to 512. Now let's go back another week, 16 through the 23rd. This is going to go 536, only by 1, but we want to make sure that the data is perfect. This is going to be 489. This is going to be 529. I just like going back just a few weeks just to make sure that we capture everything perfectly. And we're going to go 476. So now it's all perfect. So let's go backwards in time a little bit and see how did the market perform over the past few weeks compared to last year. Here we've got the ratio for this week. 2 weeks ago, we finished at 0.78. You don't see a red dot next to that. That red dot is your visual cue that that week underperformed the same exact week last year. So we can see that from February 9th through February 16th, we were at a 0.81 ratio, but the same week last year was 0.83. We had 3 weeks in a row where this year underperformed last year, meaning the buildup of inventory was higher than last year. Here's the good news. Oh, we've got should we have a green dot if we overperformed? That's not a bad idea. That's not a bad idea. Send me that as an email. I'll play around with it. I'll add a green dot, kind of get some feedback from some of you amazing visual people. And that might be a good idea. It's like, hey, Red, I like that. The more that I think of, what do y'all think? Let's do a little impromptu little vote right here. Okay, we've got, I like that. If we get 5 people saying I like it, then we're doing it. We've got 2 down, 3 to go. Okay, 3 down, 2 to go. We've got 3 down, 2 more people, and the green dot is going to be real. I might have to do something different than a dot, but that's okay. I'll figure it out. Or maybe like a green plus sign, or I'll do like a negative. Okay, good stuff. We're doing it. Melanie Price, if you could send me an email, that would be great, and I will get that done. Good news, you all, 2 weeks in a row, even before this week, where new listing to pending ratio is outperforming last year. That's really good. Now, let's take a look at this week so far. New listings, we are at 1,282. Wow, okay, interesting. 1,282 new listings. We're going to see how it compares to the same week last year. Keep in mind, this information is going to be updated first thing tomorrow morning. So when you wake up and you check your email, you're going to see an email from me with the updated. Let's take a look at price increase. We're at 246 price increase. Let's look at price decrease. We're at 1376, 85%. Do you notice that we are just staying put right around that 83, 84, 85%? That is the ratio between, out of everything that went up in price as opposed to down in price, what percentage went down in price? Let's go backwards in time a little bit and see what the first week of March was as far as a price percentage. First week of March, we were looking at 90%. First week of March, out of everything that went up or down, 90% went down in price. Now, we're holding at 85. That is another indicator of improved market condition. Let's go to back on the market. That's at 195, back on the market, 15%. Now let's take a look at active under contract. This is good, 448. This is a good number for us to start. That's not a bad number at all. Don't look at this number and say, well, that's underperforming last week. Because keep in mind, it's only 10:18 in the morning. Agents are still going to be updating this, and they're going to be updating this for the next 2 weeks. Now, you know the drill. This is where you get to guess. You get to guess how many pendings. I need 5 people. Okay, Melanie Price is going to start us off with 276. Bullish, I like it. Ryan is going to come in at a fairly bearish 199. He put a 1 in front of that. We've got Sonia at 259, coming in closer to Melanie in a way. We've got 3 down, 2 to go. We've got 276, 199 at 259. Precious coming in at 237. John D closing us off at 240. Daniel Caballero coming in at 270. And the number comes in at 247. Not bad. I know you're looking at this number saying, whoa, wait a second here, 0.47. How is that good? Keep in mind that this is really early. We've been doing this for so long that we can get a really good sense of where this is going to take us. I can tell you right now, last year, the ratio was 0.63. We are going to outperform last year. I'll tell you right now, we're going to outperform. When we update this time next week, we will already have outperformed last year. That's another good thing. So really encouraging. Now let's take a look at the year over year. Year over year, so far, we're down 13.9% on new listings. 2 weeks ago, as projected, we were down 5.5%. And look at the pendings. We're only down 1.5% on pendings. We're only down 16 pendings compared to last year. That number's going to go positive. From February 9th all the way to February 23rd, we outperformed last year on pendings. So for 2 weeks, we outperformed last year at 123 more pendings. We're under 16 2 weeks ago. That's going to go positive. This number is going to be really close. We're down 34.7%. That's a pretty big gap. The reason the ratio is going to outperform last year is because we're going to be negative on the number of new listings entering the market. I promise, especially with the rain, people don't like putting their houses on the market with rain. They're going to wait another week or so. Like that's going to happen. But we're going to underperform 2 weeks in a row on the number of new listings. Look at that. We're underperforming price drops by 226 so far. We outperformed last week, but there's a big reversal there. So overall, good news. Let's take a look at the monthly. First thing I'm going to do is go back in the month of February, see if we need to update anything. That comes in at 1754. Also have some really good news on the monthly data. We want to capture the weekly and then also the monthly. This stays the same. Let's go ahead and update the February active under contract, see if that has to change. That stays the same. Here's the good news. February 2026, ratio 0.77. Last year, 0.75. Better. 0.74, January. Last year, 0.69. Better. So we've got January and February outperforming last year's January and February. And we have the first 9 days outperforming last year, which means we're only 9 days into February, but so far, very positive for the month of February. Things are looking good for the month of February. More demand, little bit of a pullback on the number of new listings entering the market. That means that inventory is not growing nearly as much as it did last year, which means your next question is, how does that play into your projection of us hitting 20,000 active listings on the market? And I told you, I was like, I feel good about that. I made that projection. I was really bullish about that. But I said, hey, we're going to have to wait until the first 2 weeks of March to see if that's going to happen. And so far, I don't see that happening all of a sudden. I just don't see that happening. I don't see us hitting 20,000 active listings based on how January and February is outperforming last year. So we are noticing a pullback on the number of new listings entering the market. It's not keeping up with last year. And then we're noticing an increase on the number of pending, which means the active, we're going to see a pressure on the active. We're not going to have as many active homes on the market because more are going pending and less are coming new on the market. When you say underperforming, you are saying that there are not as many, so the number of homes experiencing price drops are less. Well, that is true. The last statement is true. We are noticing less listings receiving price drops. That's exactly it. So this number, let me go back to that one, and you look at 85% versus 90%. So we've got 8 out of anything that could go down in price or up in price, that price movement, 85% have gone down in price as opposed to the same week last year where it was 90%. Now, let's start updating the month of March. This is going to be your month to date. New listings 1340. Price increase 263. Price decrease 1425, 84%. Wow, that's a good number. We have not seen that number. We have to go all the way back to, January 2025, 82%. February, it was 89. We're at 84 right now. That's good. Let's take a look at back on the market. We're at 201 back on the market. Active under contract, 501. Pending, first 9 days, 294. 0.52 ratio. But once again, keep in mind, only 9 days into the month, that's not a bad ratio. Sonia said, I feel like a lot of homes will come on the market in the next 2 weeks. Is that just my experience? No, not at all. You're absolutely right. That's where the first 2 weeks of March, it's key for us to discern how the selling season is going to be. Last year, new listings just exploded in that first 2 weeks of March, but we're not seeing the same level of explosion. Already, it's March 9th. We're not seeing the same trend this year than we saw last year, and we've got the data to prove it. I'm going to show you on the graph. Number of withdrawn so far, we are at 170 withdrawn, and then expired, we're at 67 expired. So that's going to be your monthly data. Let me go ahead and just save this really quick. We're going to take a look at the daily briefing. This is something that we put together every single day, Monday through Friday. You can find that on teamprice.com. If you go on teamprice.com and you scroll down a little bit, you click on that daily briefing. You can go backwards in time and take a look at the past few, but this will always have the latest and greatest. And I'm telling you this right now, this is what I take at every single one of my listing presentations and buyer presentations. Out of the 2,500 plus pages of stats that we update on a daily basis, this is going to be the 36 pages, the 36 reports that just communicates the reality of the market at a macro level. And then at that point, you can start drilling down to the city, to the zip code, to the subdivision. So this for me is a lifesaver. Let's take a look at it. Some numbers to highlight: 8.5% active, 8.5% year over year. Take a look at that email that I sent you this morning. That 8.5% is not bad at all. That's actually a really good number. That's the lowest level year over year that we've seen in 2 years. That's the lowest level of year over year active listing that we've seen in 2 years. Pending, take a look at that number. Y'all, we're up 6% year over year on the pending. Really encouraging. Here's active listings. Last year, the market peaked June 30th at 18,146. We're currently at 13,842. Out of all the 13,842 active listings, 47.3% of them have had at least one price drop. This time last year, it was over 52%. Now we're at 47.3%. That's another bit of good news. Active listings. This is where I want you to pay attention. Take a look at the difference. This right here was March of last year. You see how that went straight up? But look, so far, we're not seeing the same level of increase. We're only 9 days into March, but there's enough data for us to say we're not seeing the same level of increase that we saw last year on the number of active listings. Pending. Y'all, we're up 7.4%. I mean, just, crazy. Let's take a look at the activity index. Activity index. Look at this. We're up 0.2%. That might not seem like a lot, but we finally broke the year-over-year drop on the activity index. We have been trailing last year on the activity index. What is that? Pending divided by active plus pending. Out of everything that could be under contract, what is under contract? And we're now outperforming last year. Last year, 23.8. This year, 23.9. I'm looking at the momentum. I am looking at once again, we're not going to be in a market where all of a sudden activity is 20% higher than last year. That's not what I'm looking for. That's not what makes me bullish. What makes me bullish is more and more is leading to the market having bottomed out already and buyers now re-engaging with the market. It would not surprise me if at the end of this year, we didn't look back, say, wow, the actual bottom of the market was 2025. Because all of the leading indicators are pointing to the higher level of demand and activity. And when we see a higher level of demand and activity, what do we see as a lagging indicator? Prices. That's what we see as a lagging indicator. Melanie said buyers are definitely coming back. Absolutely they are. We're noticing increase in activity. What was the rate this time last year? This exact date last year, 23.8%. Oh, what was the rate? You're talking about mortgage rate? Well, let's take a look at that really quick. Give me 1 second. We're going to go to even though we don't use the drive as much as we use resources, I keep all of the rate sheets, every single rate sheet. So let's take a look at March. We've got March 7th. We've got March 10th. Let's take a look at March 10th. Rates, so 6.5. 6.5. And what are rates right now? Today, good segue into rates. Rates today are 6.125. So better rate environment than last year. Last year, 6.5. This year, 6.125, which is good. Activity index on resale per city and per zip code. Buda, number 1 at 30%. Buta's doing really well. On the zip code side of things, you've got 2.8 at a whopping 53.57% activity index, which is crazy, crazy good. It's amazing activity index. That means that more than half out of everything that could be under contract, more than half is under contract. These are the zip codes. If you're over 30%, don't be surprised if you send in an offer, you go and you show that property to that buyer, and everything about that property is amazing. It looks good, it feels good, it smells good, it tastes good. And you call the listing agent up, and your buyer's now reading the headlines. Austin's the worst market in the nation. I just read the Freddie Mac report, and it said that Austin market is down. So I want to submit an offer 10% under list price. You call the listing agent, and then if you're in 28394917, that agent could say, hey, we're multiple offers. That's what's happening in those zip codes. I reviewed a contract on Friday where multiple offers. Where was it? 78717. And the buyer's like, well, what are you talking about? It's a buyer's market in Austin. That is what prompted me to write the following on the weekly update. If you look at the language that I chose to use on the weekly update, it was very purposeful. Let me go get that weekly update. No, I don't want that. Where is the weekly update? I posted a lot of articles this weekend. Right here. My title was Stop Treating Austin Real Estate Like It's One Market. It isn't. Suburbs, inventory up 10%, prices sliding. That's a fact. City of Austin, inventory down. Your zip code is your market. That's the language that we have to be communicating with clients. Your zip code is your market. I love looking at the macro market. People are drawn by the macro market. Headlines are written about the macro market. And the macro market is going to continue to experience pressure. Wait until the next national level report comes out, the next home price index comes out. It's going to paint Austin in brutal conditions. Why? Because the next report is going to come out March for what month? For the month of February. What was February like when you look at the sold price? It was terrible. February, we hit some really bad sold price numbers. But that's the entire market. That's why we create the zip code specific reports that you have to rely on. What am I talking about? Let's go back to teamprice.com. You scroll down. there's your data and analysis. Click on that middle link, and you've got specific zip code reports for all the 75 zip codes. And what's that number one zip code that we were talking about? 78728. You click on 78728 and you get all of the information on 78728. This is what you need to be taking to your listing presentation, your buyer presentation, because look at what's happened with the activity index in the 78728. Shot up. That's your leading indicator. Look at months of inventory. March of last year, months of inventory in this zip code was right around 7. What's that now? Under 2, 1.56. Amazing what's happened in that zip code over the past year. And we've got these reports on all 75 zip codes. So you've got to be obsessed with that local market. And that's what we're communicating. It's like, stop treating Austin real estate like it's one big market. Melanie said, I love the zip code activity index chart for buyers. It helps so much when it's time to submit an offer. Love it. Thanks for the feedback. And then, of course, because we treat every zip code like a unique zip code, we also take a look at the zip codes that have, 15%, 14%. You've got zip codes, whether it's, these top or bottom 4, bottom 5, you can't give stuff away in these zip codes. This is where your buyer's going to have a lot of leverage. That's why you have to be obsessed with this. Okay. Ratio for the month, 0.5. Let's keep on going. For the months of inventory, here's another really encouraging chart. We're now up by only 8% on months of inventory. And do you see how this line shot up? And then this one right here even started shooting up back in February. Right now, we're noticing a consistent growth. There could very well be a moment here where this year underperforms. When you look at months of inventory, meaning better, so you could say overperforms, where we've got less inventory this year compared to last year across the entire broad market. What's already happening is in certain markets like Austin, we already have less inventory this year than last year. We've got 5.31 months of inventory this year compared to 5.98 March of 2025. Violet said, all good to compare activity index and zip code to subdivision. Completely agree, because, and even within subdivision, right, Violet, this is something that we talk about a lot. You have zip codes that the west side versus the east side is completely different. Big mistake that I made as a brand new agent when I started targeting Steiner Ranch is that I did not discern, because of my lack of experience and therefore lack of wisdom, was that Steiner Ranch is not one subdivision. Each little pocket of Steiner Ranch is its unique little submarket. So I priced a property, my first listing in Steiner, I priced it as this is the median and median price per foot, and this other property, without realizing that where I was listing was like the least desirable section of Steiner Ranch. It was like the poor section of Steiner Ranch. But I was pricing it comparing a like property in a more desirable section of Steiner Ranch. And then thankfully I learned it's like, no, you've got to be obsessed with this little pocket of Steiner Ranch. But take a look. We've got which cities are now with less months of inventory this year compared to last year. We've got Liberty Hill, Taylor, San Marcos, Round Rock, Lago, Austin, Georgetown, Dripping, Leander. Months of inventory is down 13.9%. Lakeway, Marble Falls. All of these markets have less inventory today than they did a year ago. Same exact. When you compare it to 2 years ago, the number of cities actually goes down by quite a bit. We're at Dripping, Wimberley, Lakeway, and Del Valley. We are projecting roughly 2,630 properties will sell. That number is going to go up a little bit. We only have 9 days worth of sold data. So we add the 9 days worth of sold data, take a look at the pending, when it went pending, and we forecast how many properties could potentially close this month, but the figures for February are hard figures. And the good news, we outperformed last February. February 2025, 1,995 properties sold. February 2026, 2,028. Good news. On the cumulative side of things, January was a pretty negative month, so we are still underperforming last year on the sold, but keep in mind, sold is going to be the lagging indicator. That shows us what went pending 30, 60 days ago. So we are backtracking a little bit on the sold. I forecast that we are going to outperform last year on the number of sold based on the number of properties that are pending right now. It's just going to take us another 30 to 45 days for the pending data to filter into the sold. Sold per 100,000 people, we are down 4.6% cumulative January through March on sold per 100,000 people. So keep in mind, what I'm noticing with the market, and I hated to use the word stabilization. I hate that word. Oh, the market is normalizing. AI just likes using the word normalizing. I even put in the instructions. It's like, you're not allowed to use the word normalizing. That's when you know an article was written by AI, because it has normalizing, stabilizing, and then it has like a dash on every other paragraph. It's like AI wrote this article, which, by the way, every article is written by AI right now. So I don't like to use the word stabilizing. I don't like to use the word normalizing. I would much rather say that everything is indicating that the market has reached its bottom, and that it's going to be a slow and gradual recovery. A slow and gradual recovery after having reached a bottom. On the activity side, we're noticing a recovery in activity. It will translate into prices in 3 to 6 months. That's what we're noticing within the market right now. Okay, that's the good news. Here's the other good news. Sold per 1,000 realtors. This is going to be the best figure going back to 2022. Number of properties sold January through March per 1,000 realtors. So we, as an industry, we're having the best first quarter that we've had in 4 years. That's really good, because we've got less realtors competing for a little bit higher increase on the number of properties. Are we down on the number of realtors? Not yet. We are forecasting a drop once those dues are unpaid and officially overdue, and that's going to be the rollover into next month. We are forecasting a drop, but not yet. Okay, you ready for some pricing information? I went ahead and pulled all of the data for March, but I don't want you to pay attention as much to March because it's only 9 days worth of data. And we know that more expensive homes sell in the first 15 days of the month. The number of cash sales are dramatically higher in the first 15 days of the month. The luxury market tends to sell more in the first 15 days of the month, and they tend to be more cash transactions. So we always have a artificially inflated average sold price and median sold price in the first 20 days of the month, and then it starts going down. But I like to see the rate of decrease. I like to pull the data. I'm always going to pull the data. I always update it after the 7th of the month. I start publishing all of the sold data. But I do want to focus on February. And February was interesting, both January and February, because we ended January at 403,750 on the median sold price. And it was dramatically less than January of 2025 at 409,462, which was the market bottom. And it went down 5,712. It's a big drop. And then we did not see as much of a recovery in the month of February. And I have this highlighted so we can just put our eyeballs here. So February, 427, February 2025, February 2026, 405. 405. Here's my warning for you. Here's my warning. Properties are not going to appraise this next quarter. Because what's going to happen? We had low demand going into fourth quarter that beat up on pricing. Sellers got desperate, did aggressive price drops. Buyers negotiated aggressively on pricing. Those properties closed January, February. Now we're entering March, April, May. So you're going to go into April. You're going to get a property under contract in the 78748, 78717. It's going to be multiple offer. And then that appraiser is going to do what? Look at that property that closed in February when it was a completely different market in that zip code. And they're going to say, yeah, the property doesn't appraise. So listing agent, be watchful. Buyer's agent, be watchful. We are going to notice properties not appraising this next quarter. The data proves it. It's going to be a fact. Be ready for it. So what are we going to start going over? We're going to go over TXR 1948, the appraisal contingency addenda. Should we use it? When do you use it? What happens if a listing agent that's tracking the market, thankfully not many of them are, but what happens if a listing agent says, hey, you won the multiple offer with one condition. We want you to select box number A on TXR 1948 with the buyer waiving the appraisal contingency. Should the buyer do that? Because that listing agent knows all of my comps over the past 3 months, 4 or 5 months, they sold way under, but now we're noticing an increase in demand. So we're going to have those conversations. We're going to review on Wednesday the contract proficiency for the previous week. The next contract proficiency, I'm going to add to TXR 1948, and I'm going to use a partial waiver so that we can start having and reigniting these discussions. What does it mean to do a partial waiver? What does it mean to do a full waiver? What does it mean to have the additional right to terminate? Because it could also be on the buyer side. What happens if you have a buyer that's putting 35% down, 25% down? And we look at the previous comps and we say, I don't think the property is going to appraise. Well, now we have to leverage that TXR 1948 paragraph C, giving the buyer the additional right to terminate so that they don't lose their earnest money, or if they don't have the willingness to come to the table with more money. So we have to have these conversations right now. And that's a reminder of our contract proficiency, you all, because we put together examples that are real life examples on deals that we're seeing right now. This is the one for this week. It's due March 11th at 9 a.m. Here's the MLS number. And what are we doing here? 0 down VA, 550. Seller pays 3% commission. Buyer wants 1% towards closing. Buyer wants the seller to pay for a new survey. Buyer wants to get the seller to authorize a hydrostatic test. These are real case scenarios. And you've got to know this information. So you have the time to complete this contract example. Send it to Gail Haggerty, docs@teamprice.com. Write this contract as if you were writing the contract for a real client. Okay, write this contract. You've got to write this contract as if you were writing a contract to a real client. I review it like it's a real client, so that when you face this situation with a real client, you don't look like a fool. Right? It's so hard to get real paying clients nowadays. It costs you time, energy, effort. And then you get a real client and they want to submit an offer on a property. And you're like, and they'd say, well, I asked ChatGPT about a property built in 1960 and they recommended that I do a hydrostatic test. What can you tell me about that? And if you're like, you're done. You're done. Like that it's gone. Like, why would they hire you? There's no point for them to hire you. So you've got to do this contract example. Melanie said, I'm doing it right after the meeting. Love it. And by the way, the other thing is this. As we enter certain environments, certain zip codes, certain subdivisions where you are experiencing multiple offers, it's going to be what is that, Jekyll and Hyde type thing, where for one client, you've got all the time in the world to write an offer. That property is not going to go anywhere. That property is going to stay in the market for another month. Right? It's like, oh yeah, let's write an offer tomorrow, sleep on it. Who cares? It's going to be 5,000 less tomorrow anyway. So why be rushed? That's one client. Another client, you show the property and the listing agent says it's 5:30 and the listing agent says you've got a 6 p.m. deadline. You've got to be ready for both clients. And if you're not practicing writing an offer every single week, no matter what, practicing your craft, you're not going to be ready for that second client. Might be $1 million transaction. Might be a $30,000 paycheck. And if you lose that client because of that, it's on you, right? I don't want to shame you, but if that's what it takes, I certainly don't mind doing it. So it's on you. Violet said, you should price drop percent last year versus this year. I do have the price drop percent last year versus this year, Violet. As a matter of fact, that is one of the things that I'm going to go over. I do have that information. So I'm glad you brought that up. I'm going to go over that information. Let's take a look at a few more things. When we plug in the March average sold price, the market is down 13.77%. It's a $94,000 drop from peak, but that does include March of this year. Let's take a look at the median sold price. The median sold price so far March is at $456,071. That is a drop of 17.8%. Here we've got that year over year gain of 4.8%. That number is going to go down because it is only the 9th of the month. Now let's take a look at the percentile analysis because something also really interesting happened. I like this percentile analysis, probably one of my favorite. This is my, back stat tattoo that I'm going to put on my lower back. I like this chart so much. And go to Porter Ranzis and show it off. This is where we take the previous 30 days sold and we compare it to the same exact time period last year. The same exact time period last year. 30 days worth of sold compared to 30 days worth of sold. How many properties sold? The bottom 25th percentile. So the cheapest 25th percent of homes last year started at 325. This year starts at 315. So the bottom 25th percentile is 3.1% in the negative. The top 25th percentile, last year, 614,990. This year, 614,750. So the top 25th percentile is down 0.04%, something that we have not seen in a while. That will cause further pressure on pricing because the market has been bifurcated for so long, where the top 25th percentile was propping up the entire market. Let's see if this is sustained or not. What is going to happen when May 21st falls off that chart? What do you mean May 21st? What do you mean? May 21st? Why would it fall off that chart?
May of 2021, the previous chart.
Oh, previous chart? Let's go. Well, I'm just going to squeeze it. May of 2022. That's when the market peaked. You mean May 2022? Yeah. So what I'm going to do is I'm going to keep on adjusting this up until it gets to January 2022. And then that January 2022 is going to lock, and then the chart will forever, till the day the good Lord takes me home, will forever keep on going. Does that make sense? Could be tomorrow. Could be, 50 years from now. God willing, 50 years from now, because I'm telling you all, I feel like I'm just getting started. I feel more excited about the second part of my life than the first part of my life, and the first part of my life was amazing. Let's take a look at appreciation. Median sold price so far this year, 7 cities are up in value, and 23 cities are down in value. That's where we take all the median price of everything that closed so far this year. And then the amazing Oliver Hall. Is Oliver Hall here on the call? Oliver Hall, you're on the call, aren't you? Say hi to everyone, Oliver, if you're able to. If you're not, that's okay. He's probably not paying attention. So I'll say hi on behalf of Oliver. Oliver said hi. There you go. Oliver Hall made a comment. And I was like, Oliver, that's brilliant. I'm going to add that to the chart. Because one of Oliver's favorite charts is this one right here. This is where we forecast the recovery of the market if today is the bottom of the market. And based on the compound appreciation that the market has experienced going back 26 years, we simply apply that. It's eye candy. It's highly inaccurate, not to be trusted, but I love it. Almost like everything in life. And this basically says if today is the bottom of the market and the market only appreciates based on its historical appreciation, how long will it take for the market to return back to its peak value? And this right here would put it at 49 months, March of 2030. March of 2030, the market will return to its peak value. Oliver made a comment related to like, well, what about certain cities or zip codes? And I was like, oh my goodness, it's brilliant. I added that formula to every city and every zip code, and I base it on months. So now it's like you take Austin, and this is based on the compound appreciation specific to that city, specific to that zip code. So thank you, Oliver. Y'all, 99% of the amazing resources that we have, it's because you all just made a comment and it was like, that's genius. Like, that's brilliant. Like, I can do that. So you take Austin. Austin is down 10.2% from its peak value using the yearly peak value. If today is the bottom of the market, it will take 27 months for Austin to return to its peak value using a 4.9% compound appreciation. Then you take a look at Buda. Buda, 121 months. Buda market is down 28.4%. Buda market has appreciated 3.4% compound over the past 26 years. Therefore, not only do we have way more to bridge that gap is way just wider by almost a factor of 3, but the appreciation is dramatically lower, almost by 40-some% lower appreciation. So it's going to take that much longer for the market to recover. Marble Falls, 174 months. By the time it appreciates, you are retired. You can buy a retirement lake home by the time it appreciates. So love this chart. Thank you, Oliver, for the idea. Really excited just to have that one little column right there. And keep in mind, yes, Smithville reached its peak. But that's, here's the thing. The reason why is because we're taking the median that sold the entire year. And Smithville is such a low market that the data for like the first 6 months of Smithville changes dramatically. Same thing is happening with Wimberley. Wimberley says that it's up 18%, which is true. It's accurate, but not many properties sold in Wimberley. So it's going to cause that number to go up dramatically. So you just have to be aware of that. That's why you click on the specific city. Let's click on Smithville right there. It pulls up the only 11 properties sold in Smithville. So take advantage of the links. In March, only 2 properties sold. Now, one thing to keep in mind, look at the pricing for January, February, and March. $395, $410, $490. So it is noteworthy. It is something that we need to be aware. But what's going to happen when we've only had 2 properties that sold at a median price of $490? Is that really trustworthy data? No, not really. Not really. We need at least, get up to like 5 or so. If we have 10 properties that sell, that number could drop 325, which is why we update this information on a daily basis. Okay, here's our home value index. Love this chart. This is where we take the early 2020 baseline median sold price. What the heck does that mean? First 90 days of 2020. What is the median sold price for the first 90 days of 2020? That was 316,283. Then we take the past 90 days median sold price. The reason I do 90 days is because it eliminates certain market fluctuations with not enough home selling. So it's really accurate. That comes into 405 past 90 days. Then I create a inflation adjusted fair value price. What the heck does that mean? What I do is I take the early 2020 baseline median price and I adjust that amount with CPI, Consumer Price Index, meaning $316,283 has the buying power because the corrupt individuals at our government keep stealing our money through devaluing of our currency called inflation, and they should all be in jail or arrested. But never mind, I said that. That has the buying power of 397,942. Meaning, and this is crazy, that the entire Austin market is only 2.02% over the inflation adjusted price of early 2020, which is insane. That puts the entire market at a fairly valued market. It's the entire gain that we had because of the pandemic has been erased. Prices today are only 2.02% higher than pre-pandemic. In pre-pandemic, not many people were saying, oh my goodness, Austin is so unaffordable. It's just crazy. You just can't buy a house. No, not really. And then you've got certain markets that are undervalued or fair. Yeah, so we've got this on zip code. We've got this on cities. It's crazy to see some of these prices. Buda down 27.4%, which is amazing. Buda now is down $1,737 compared to what? A pre-pandemic pricing, meaning prices now are less than pre-pandemic in Buda. Well, and I get it. Okay, but if you're getting a loan, rates back in early 2020 were a lot better. Therefore, your PITI would have been better. I get that. I completely get that. That is valid. That's what's causing the market not to go up by 20% in the number of pendings. That is what's causing that. Pricing wise, super attractive, very attractive pricing. Then we've got two additional figures that I want to show you. This is going to be the absorption rate sold divided by active. We're at 17.39%, dramatically overperforming January. That is an improvement. That's going to beat last year. February last year was worse than January of last year. This year, January was brutal. It's not looking good. February looking really, really good. I'm not going to add the March figure until the last 5 days of March. That's when I add the March figures because we don't have enough sold information. That number would collapse. And then one of my favorite ones right here, this is if we combine everything, if we combine absolutely all the data that we pull, everything, pending, days on the market, price drops, active to sold ratio, demand velocity, you name it, and we rate the market between 0 and 10. 0, you are going to starve to death. 10, you're going to buy a beautiful steak dinner and you just are making more money than you could ever imagine. Where's the market right now? And then what's the rate of improvement? Meaning what I'm looking for here is this number outperforming the previous year 4 months in a row. That's what I am looking for. Mark my words. We are going to experience that in April. In April, this number is going to outperform April. If it goes April, May, June, July, market recovery. The bottom already happened. This is a leading indicator. If all of a sudden we start backtracking, there's a lot of things going on right now that could completely changed the direction of the market. We've got conflict, war going on in the Middle East. We've got oil over $100 a barrel. This is an election year. But that's why we update this information, right? So we update it daily. We know what's going on. But I'm telling you right now, first quarter of the year is looking really positive. It is 11:04. I only want to show you two more things. One of them is the chart that Violet mentioned. This is going to be the pending year-over-year change. We can see where we are right now. This is where we are. This is where we were February or March of last year. Pending, we were negative over 10%. Right now, we are positive, which is really, really good. This is going to be the pending year-over-year change. So overall, things are looking good. I'm excited. Good to see activity picking up. And then the last thing I want to go over is the economic calendar. You can see behind me that the bond market, thankfully, is only up by 0.4 of a point. We started off the day terrible. You can see behind me right there, that's the 10-year Treasury bond market. Started off the day terrible. I was like, don't even want to go to work. No, I didn't say that. I love coming to work. But it started off terrible. Good news, it corrected. We had a 3-month auction that came in. Oh, let me change that drawing. That was terrible. We had a 3-month auction that came in better than expected. That was good. Really big week for rates, you all. Take a look at that email that I sent you. It shows you when to advise clients to lock. We've got business optimism coming in tomorrow at 0.4. Wait, are we UTC 6 or UTC 5? We're UTC 5, or I think we are 6. Oh, that's right, because of daylight savings, right? Okay, so we've got National Federation of Independent business optimism coming in tomorrow at 4 a.m. They're forecasting a 99.7. The previous was 99.3. No, it's not going to come in at 99.7. I think it's going to come in like at 98. We've got ADP employment change. We had terrible employment numbers last week. We've got existing home sales. That's going to be good. We've got inflation. Big one's going to be inflation. We've got CPI. That comes out on Wednesday. Wednesday's going to be a really big day. I'll go over this during our Wednesday training, Wednesday meeting. We've got a lot of commodity data related to energy. That comes out on Wednesday also. We've got a 10-year bill auction. That comes out at 11 a.m. on Wednesday. That's going to be big. We've got building permits, housing starts. We'll be able to update a lot of our resources. That's going to be on Thursday. And then the big one is going to be Friday. So it's going to be a combination of Wednesday and Friday. Wednesday and Friday are going to be the big days for economic data that's going to move the market in one way or the other. We've got PCE, personal consumption expenditure. That's also an inflationary indicator. We've got JOLT, job opening, labor turnover. We've got a lot of data. We've got GDP data coming out. We've got a ton of information coming out. So Friday is going to be a really big meeting where we're going to recap all of this information, see how it affected the bond market. My recommendation is going to be a lock and float strategy for a client because of the level of volatility that we will experience this week. Rates are not going to be steady this week. It's going to be a crazy volatile week. We don't know what GDP is going to come out. We don't know what employment. We don't know what business optimism. We don't know what PCE. We are noticing a combination of bad job numbers with a higher inflationary environment. And that brings us the famous stagflation word. Are we entering a season with a stagnant economy with inflationary pressure? That's the word that people are using. And this week is going to give us a lot of data to see if we're entering that. And of course, we know that buyers make decisions to buy when they're confident and comfortable with their economic outlook, with a decent rate environment and decent prices. We've got the decent prices. We had a way better rate environment 2 weeks ago. 6.125 isn't bad. 5.98 is a heck of a lot better, even psychologically. Builders are offering amazing incentives. So we have a semi-decent rate environment. The component that we're missing is that confidence in the economic outlook for the next year, 2, 3 years. That's something that's missing. And this week is going to give us some data to show us, is that environment getting worse? Is that environment getting better? So we're going to discuss that on Wednesday, also on Friday. And I do want to remind you, we have our Wednesday meeting at 10 a.m. Do not forget to join us for our Wednesday meeting at 10 a.m. over Zoom. That's where we're going to go over the contract proficiency, lay out the new contract proficiency, do broker Q&A. And then we've got our Friday meeting. Our Friday meeting is going to be live in person at the Austin Board of Realtors. First hour from 9 a.m. till about, well, first 45 minutes, 9 a.m. to 9:45. We do a focus group, mentorship focus group, smaller group of people, totally voluntary. Show up if you just want to, be held accountable, hold yourself accountable, encourage other people, get encouragement from people, share what you're doing, what's working, what's not working. And then 10 a.m., we have our meeting that'll last about 90 minutes. Are there any questions, comments, concerns, criticisms, or complaints? It's 11:10 in the morning. Are there any questions, comments, concerns, criticisms, and complaints? Going once. Going twice. Good stuff, you all. Good stuff. Thank you all so much for being flexible this past Friday. Where can I find the contract proficiency? Let me send you the link right now. If you go to resources.teamprice.com and then we go to learning and then contract proficiency, you can get that right there. But there's the link. I will also email you the link to make sure that you have it. If you check your email right now, contract, and I'm going to send you to both of your emails. So that you've got to log in with your Team Price email. So it was emailed to you, and then there you have it. Thank you all so much for being so flexible with me this past Friday. I was in the terrible city of Las Vegas. Can't say beautiful. There's nothing beautiful about it, in my opinion. But it was great. The kiddo did well. 8 points in 4 games. Got player of the game. Got a hat trick, and they won. So that's pretty exciting. Kiddo did really well. Let's see. I got, they did great. So I'm super proud of her. It was a fun game. I don't know. Let's see. I think I've got a, you can log off if you want, by the way. Not a big deal. But I've got, do I have one that kind of shows she got beaten up pretty bad? Look at it. Let's see if we can see. That's going to take too long. It's going to take too long to, it's kind of like buffering. I hate it when these things buffer. Hey, look at that. That's her like that. That's her right there. Just battling it out. So just like, so we had a great time. Vegas is okay, but we had a good time. And thank you all for being flexible. Super appreciate it. Hope you have an absolutely excellent rest of your day. If you do have any questions, comments, concerns, criticisms, or complaints, let me know. Here to help. Otherwise, I will chat with you later.